You tracked every single dollar last month. You stuck to the budget, skipped the impulse buys, and packed your lunch. And yet, when December rolled around, that money you worked so hard to accumulate bought less than it did 12 months ago. That drop in purchasing power is inflation. It quietly takes a piece of what you save, while the cash just sits there. You did not fail at budgeting. Your willpower was fine. The problem is the physical place where you decided to store that cash. So right now, look at the interest rate on your primary savings account. This graph shows exactly what happens to that money. The flat bottom line is a standard savings account earning mere zero, while the sharply rising line above shows the cost of living. Moving emergency funds into a high-yield savings account lifts that bottom line. It will not completely erase inflation, and the interest rates do fluctuate, but it forces your cash to lose less ground while remaining easy to access. A bulletproof budget loses its power if the resulting cash is stored incorrectly. Placing your money where it can grow is a mandatory step for keeping your wealth intact. Take someone like Alex. He spent a full calendar year on the tightest budget he had ever built, assigning a specific job to every single dollar. By the following January, his grocery bills were higher, his electricity rate jumped, and his medical prescriptions cost more than they did the year before. He felt incredibly proud of the balance sitting in his savings account, right up until he realized that exact same balance could no longer cover those daily expenses. Inflation cannot be treated as random background noise. It is a predictable, guaranteed expense that has to be factored into your financial planning from day one. When everyday items get more expensive, money sitting in cash does not automatically multiply to cover the difference. That is the core mechanism of purchasing power. This diagram illustrates a starting balance of $10,000 at the beginning of the year, perfectly covering a specific amount of groceries, transportation, and home repairs. Watch what happens by December. The $10,000 number stays exactly the same, but that same balance now covers fewer weeks of food, fewer rides across town, and a smaller portion of that home repair. Not a single dollar physically disappeared from the account. Its capabilities simply compressed. Most traditional money advice focuses entirely on two actions: earning more and spending less. Those habits matter, but they fail to solve the problem if the capital you successfully save is deposited into a vehicle barely growing at all. This diagram of a bathtub represents the standard approach to accumulating wealth. You have an input faucet at the top labeled "Earn More," and the solid walls keeping the water inside are labeled "Spend Less." Your disciplined saving habits keep the water pouring in, filling up the tub. But inflation acts as a hidden drain at the bottom, leaking water out at a rate that almost matches what you pour in, keeping the level exactly where it started. It is slow and quiet. You can easily miss it until you step back and realize your money is not stretching the way it used to. Plugging this drain does not require taking wild, risky bets in the stock market or becoming an overnight financial expert. It just takes a few practical, low-risk adjustments to where your money sits. Keeping your cash safe in a static vault is not the same thing as keeping its value strong. To protect your wealth, you have to actively manage inflation. When the price of your favorite coffee beans jumps for a week, it is an isolated event. Inflation is different. It is a slow, systemic rise in the cost of almost everything you buy. As those broad market prices creep upward, the mechanical effect on your money is absolute. Every single dollar you hold buys a little bit less today than it did yesterday. This creates an invisible drain on your wealth. It doesn't matter if you make $30,000 a year or $300,000. If the purchasing power of the currency itself is eroding, your resources are constantly leaking away in the background. To see how purchasing power actually works, let's look at a perfectly closed system. Imagine a local market with exactly 100 apples for sale and exactly $100 in circulation to buy them. Now, watch what happens if new currency floods into the market, but the number of apples stays exactly the same. You have more dollars chasing the exact same amount of goods. The reverse creates the exact same problem. If the money supply stays flat, but a bad harvest wipes out half the apples, you now have a surplus of dollars fighting over a sudden scarcity. In either scenario, the math only resolves one way. To balance the system, the unit price of those remaining apples has to go up. The modern global economy has millions of moving parts and complex financial instruments, but beneath all that noise, this simple ratio between the supply of goods and the supply of money governs what your paycheck can actually acquire. The math is unforgiving. Anytime market prices accelerate faster than your personal wealth grows, you are actively losing financial ground. That abstract math gets very real when it hits your household. If your income is fixed, you are completely exposed to these external economic shifts. Three distinct macroeconomic pressures force those prices upward: a sudden surge in consumer demand, a bottleneck in global supply chains, or rising operational costs for the businesses actually making the products. To the global markets, those are three very different problems. To you, the origin of the pressure is irrelevant. The strain on your wallet feels exactly the same. Because your living expenses are climbing while your earnings stay flat, your paycheck simply cannot stretch as far as it used to. Mathematically, it functions as a recurring, silent pay cut. And the situation is usually worse than the headline numbers suggest. Broad national inflation averages smooth out the data, creating an illusion of a manageable increase. Prices don't rise evenly. Economic pressure concentrates on a single sector. Housing absorbs the shock, sending rents skyrocketing. Then the market pivots overnight, slamming directly into food or utilities. If your largest bills are in these categories, your income is forced to its breaking point. An average inflation rate of 4% sounds entirely manageable on paper, but that average offers zero protection if the specific cost of your daily survival is surging at 10 or 15%. When faced with this pressure, the standard advice is almost always to rely on a strict monthly budget. A budget is an excellent tool for controlling your immediate outflow. You can cap your spending and eliminate waste. However, it fails entirely at protecting the actual stored value of the cash you manage to keep. Even with flawless discipline, if your fixed living costs steadily climb while your income remains stagnant, your financial safety margin gets thinner and thinner every month. And the capital you do save faces its own quiet erosion. If you are holding your liquid cash in an account with minimal yield, inflation is actively consuming your principal while it sits there. Cutting back on expenses is only half the equation. Traditional restriction is an incomplete strategy unless it is paired directly with proactive wealth protection. Effective financial defense requires moving beyond simple frugality to intentional strategic spending. That requires repositioning your liquid assets. You have to move your cash into environments mathematically optimized to match or outpace the systemic rise in market prices. And there is a critical window to make these adjustments. You must secure your capital before a series of minor compounding price hikes turn into a permanent structural squeeze on your daily budget. But this is exactly where most people make a critical error. When feeling the squeeze, human instinct drives us toward reactionary, defensive financial behaviors. These snap reactions feel smart in the moment and provide immediate psychological comfort. Yet structurally, they almost always guarantee a far worse financial outcome down the road. Preserving long-term purchasing power requires two things: placing capital in the right environment and avoiding the specific, counterintuitive traps that make the squeeze worse. You go to the grocery store, check out online, or open a utility bill, and the numbers staring back no longer make sense. Everyday costs have suddenly ballooned out of proportion. When that inflation shock hits, a quiet psychological shift happens. People abandon their calm, long-term financial plans and surrender to immediate, reactive instincts. These knee-jerk reactions feel entirely logical in the stress of the moment. You want to fix the pain quickly, but those rushed responses actively make the underlying financial problem worse. Knowing how inflation works in the background is useless unless you can explicitly identify and stop the 5 reactive behaviors that destroy wealth. Let's start by looking inside your banking app to identify mistake number 1, dropping your savings contributions to 0. When everything gets more expensive, those immediate bills demand your attention. Pausing a flexible savings transfer feels like the easiest, fastest way to free up cash. This bar chart compares a baseline emergency cost from last year with the projected inflated cost of that exact same emergency today. Because the baseline cost of goods is rising, future emergencies, like a broken car or a medical bill, are becoming more expensive too. Halting your savings now leaves you exposed to those much larger future shocks. The proactive solution is to maintain even a tiny automated transfer. Keeping a small amount moving preserves the financial habit and prevents you from having to rebuild momentum from scratch later. Then the inevitable psychological burnout hits, leading directly to sudden, massive rebound spending. A sustainable alternative is to make a few precise, manageable cuts that you can actually live with long-term, instead of turning your daily routine into a punishment. Treating your personal budget as an emergency lockdown guarantees failure. Sustainability and consistency are your only true defenses against rising costs. Now, picture sitting at a home office desk with your budget planner. This is where mistake number 3 happens, forcing old prices onto a new economic reality. This graph illustrates the subtle conflict in your planning. The flat line shows predicted expenses based on old data, while the sharply diverging line shows your actual current costs. You are expecting last year's perfectly balanced numbers to keep working today. Even if your habits haven't changed, relying on that outdated math creates an invisible deficit. It constantly makes your budget feel broken, pushing people into guilt and random, disorganized cuts. The strict rule to follow here is simple. When external prices permanently change, your foundational planning numbers must be updated immediately to reflect reality. Next, step into a grocery aisle to see mistake number 4, stockpiling goods out of fear. The logic assumes that if prices are going to keep rising, it makes sense to hoard duplicate items right now. But hoarding behavior aggressively pulls future spending into the present. It devastates this month's available cash flow without creating much real savings. Strategic bulk buying has its place. Panic buying, however, generates significant secondary risks, namely the massive waste created when you overbuy perishable goods. Both of these mistakes severely warp your cash flow because they stem from refusing to engage with the present reality. One lives in the past, and the other fears the future. Finally, imagine someone staring frozen out of an office window. That stillness captures the final mistake, waiting for everything to go back to normal. It is the most common human response to inflation. People notice the higher prices, complain about them, and then make absolutely zero behavioral changes. Look at this line graph plotting overall price levels. It shows prices rising sharply and then plateauing at a high level. While the rate of inflation may cool down, aggregate prices rarely drop back down to their previous historical baselines. Freezing in place and waiting for a magical reset simply allows compounding inflation to silently erode your wealth month after month. Zooming out to view your holistic financial picture, we need to address the stress caused by these reactions. None of these 5 mistakes stem from carelessness. They come from the very human instinct to solve a sudden problem too quickly. Consciously avoiding these reactive pitfalls stops the financial bleeding. It gives you the mental space required to step back and respond effectively. Clearing out that reactive panic is the mandatory first step. It provides the clear runway you need to finally build and execute a structured, practical financial plan. The checkout total is higher, the monthly bills are heavier, and a quiet, constant tremor is shaking the foundation of your household budget. It is easy to react to that invisible pressure with panic, or by simply ignoring it. There is a better response. You can replace that sense of helplessness with a sequence of practical, immediate adjustments to your financial routine, most of which cost exactly $0. When you shift from passive observation to active adaptation, inflation stops feeling like an overwhelming macroeconomic crisis. It breaks down into a series of highly specific, manageable variables. The first step of this blueprint is to run a targeted price audit on your recent spending. Pull up your bank statements from a few months ago and compare them to your current outflows. Focus on the major categories, internet, insurance, and childcare, to see where the numbers have actually moved. This chart compares assumed inflation against actual localized price spikes. The goal is separating emotional assumptions from the reality of exactly where prices spiked. Identifying these specific mathematical pressure points lets you formulate a precise counter-strategy for the exact category squeezing your wallet. That leads to step 2, systematically requesting better rates on your largest recurring bills. You do not need to be aggressive with your insurance company or internet provider. Simply use polite clarity to ask if there is a cheaper plan or an unadvertised less small in isolation. But because it applies to a recurring bill, that permanent reduction compounds favorably over the entire year. Step 3 is to transition to a dynamic, regular schedule for your budget reviews. Building a budget once and never looking at it again works when costs are stable. When prices are shifting, you need quarterly check-ins to catch those changes before they turn into overspending or debt. Rigorously managing these outflows establishes a firm defense system. It stops slow price creep from quietly accumulating and undermining your financial health. Now we pivot from defensive cost-cutting to offensive planning. Step 4 involves building a dedicated inflation cushion into your savings goal. If you usually save $300 a month, try nudging that target upward incrementally. This accounts for the fact that the dollars you save today will have decreased purchasing power in the future. That leads to step 5, matching the job to the money. Not all of your saved cash belongs in the exact same financial vehicle. For cash you might need soon, you want a high-yield savings account. A high-yield savings account is a deposit account that pays an interest rate significantly higher than the national average, making it ideal for short-term emergency cash that requires total safety and immediate liquidity. This diagram shows your capital splitting into 2 distinct paths based on time horizons. While your short-term cash sits safely in a secure, stable account, your long-term capital moves into diversified, low-cost investments. Despite short-term volatility, these investments follow a long-term growth curve that has the historical capacity to outpace the baseline inflation metric. While you place your capital into these specific areas, you should also apply step 6, strategically locking in your fixed costs. This often means transitioning from monthly to annual billing for your key services. Locking in select costs provides a stable foundation of predictability. It gives your budget breathing room while your other variable expenses continue to fluctuate. Finally, we reach the 7th structural requirement. You must actively work on the income side of the equation. Stagnant wages represent a functional pay cut when the cost of your daily life continues to climb. You need an active remedy. Prepare a merit-based case for a raise at your current job, or explore acquiring new skills and establishing a side income to keep your earnings ahead of rising prices. Cutting your costs defends your current baseline, but optimizing where your cash sits and deliberately increasing your overall inflow is the only mathematical way to truly secure your future purchasing power. Building an adaptable system matters far more than pursuing the illusion of financial perfection. It comes down to 3 core points: a budget that responds to reality, savings placed according to specific time horizons, and protected income growth. If these practical strategies gave you a clearer way to protect your cash, leave a like so I know to keep making videos exactly like this. And if you know someone who budgets carefully but still feels like they are falling economically behind, send this video to them. Comment below with your biggest price jump. I post new videos every Tuesday, Thursday, and Sunday, so hit subscribe to make sure you catch them. Lasting financial resilience is achieved through continuous, thoughtful realignments to the world as it actually is. I will see you in the next one.